Hi everyone, I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, it's been a surprising week, at least to me, and we're going to talk a fair amount about that in this week's show. As we record right now, late morning on Tuesday, the S&P is up about 19 points to another all-time high. Earlier today, it got as high as 3376. Currently trading 33.71. So this puppy just keeps going and going regardless of what's going on in the world. And we will spend a fair amount of time talking about that today. So I've got no public appearances coming up that I need to inform you about. By the way, I was down in Orlando for the Money Show. Actually had a very nice conversation with Dave Keller that we recorded an interview too, so hopefully that will hit up on StockCharts within the next week or two after they get through all the production of it. Nice seeing a lot of people down there. I've been speaking at money shows and traders expos for about 20 years or so, so know a fair amount of people already. And looking forward to the next one in the spring. I'll be doing another one. Haven't worked out details yet, but potentially Chicago, I think is, and maybe even Las Vegas are the ones that are coming. Anyway, today we're going to spend virtually the entire half hour within kind of looking at the S&P itself. And it won't always be the S&P 500. Sometimes we'll be looking at the S&P 100 and even the equal weight S&P. But it's going to basically be about what's going on in the market and the different ways of looking at what's going on in the market, depending upon which chart you pull up. And there's lots of different ways of looking at the S&P 500 or the S&P 100 and so on. So we're going to take a look at that today. And so we'll do the normal sector review. We'll get to the S&P and then we'll look at these different market caps. But also notice that in today's agenda, I've highlighted in blue here, it doesn't matter what I or you think about the market. And I want to talk a little bit about this because this is, excuse me, often the essence of becoming a successful trader. And part of that is putting the ego aside, putting the it definitely has to be this way aside. In chart perspective, it could be, well, a trend line broke to the downside, therefore we're no longer in an uptrend, and even if the market turns around and goes higher, you're kind of sitting there with crossed arms and going, no, this should be a downtrend. And the reality is, it doesn't matter what you think the market should be doing. What only matters is what the market is doing, and then how you play that. Now, you can choose not to partake if it's moving in a direction opposite to how you think it's going to move. That's fine. All is potential opportunity cost. So let's say you're bearish the market and the market moves higher and you say, hey, I'm not going to come in and play this. That's fine. Your money sits in the bank or somewhere. And if you're not content with the risk you have to take, then you simply just miss the up move. It's not hurting you financially other than you're not partaking in making money, but you're not losing money because you decided, let's say, not to play a bullish move in the market. But what's really important here is to separate as a trader, and this is where psychology comes in, as your own psychology as well as your whole come from about what you want to achieve in the market. To me, what I want to achieve is making money. It doesn't come with ifs, ands, or buts, and it doesn't come with a whole set of rules that I get stuck on, other than my rules of discipline specifically related to a position when I put something on. And my view recently has been, over the last week, week and a half or so, is that I had lowered in my institutional newsletter, I had lowered exposure in the S&P to 100% exposure in the underlying basket of stocks that a portfolio manager would have, which, and the way we trade this is, I assume you are always long a full equal amount of dollars in your portfolio to the S&P 500. In other words, you're always fully invested. And then what we do is we leverage higher. So if I'm bullish, we'll add futures exposure or additional spiders. We'll leverage the market going up. Or if I'm bearish, we'll actually take away some exposure to the full S&P 500 exposure. But basically, my come from is you're always, my suggestion to a portfolio manager is you're always fully invested, and then we can play and leverage it higher or reduce the leverage or actually take it down so that you don't have the full exposure to the S&P. So what I did a week and a half ago was when we sold off, now even though we hit our initial downside target, I still have concerns that the marketplace is not taking coronavirus as seriously as my sources tell me they need to. So I took away leveraged exposure, basically saying if the market goes up, we'll make what the market makes on the upside. If the market goes down, we'll lose what it loses on the downside. But I didn't want to have any additional leveraged long exposure, which is what I almost always have when I'm bullish. So I've gone fairly neutral to market. And here we are gapping to all-time highs, massive recovery, off of this propulsion downside target at 32.25. And so I can look at this and say, I'm wrong. And the reality is, yeah, I'm wrong because the market came storming back. But I have this, this belief that things will get worse with coronavirus. And that, again, the marketplace is not taking this as seriously as it could. Now, without getting all doomsday type of analysis, maybe investors in the U.S. aren't going to take this seriously until some American on U.S. soil gets this or dies from it. I don't know what's going to take for people to kind of take it more seriously, but nonetheless, the market is up on all-time highs. And I have to look at that and say, it doesn't matter what I think the market should do. All that matters is what the market is doing. And the market is making new all-time highs. And therefore, I need to adjust my scenario analysis to that, regardless of what I think. Because if I get stubborn about my thought, and I'm not in the medical community, I'm not a doctor, it's just about what I read and from what sources tell me, and these are what I believe to be well-informed sources. To me, and from what I hear, this is going to be a bigger problem. And it's not a matter of when it gets to, or if it gets to the U.S., it's only a matter of when. But ultimately, this will be a problem for the world to deal with at a much greater level than people are taking now. So it's hard for me to buy into this market based on my thoughts, but my thoughts are not really what matters. The market is what matters, and the market is telling me I need pay attention to the fact that we recouped the entire decline and have actually moved to all-time highs. So it forces me to put on some new exposure again on the long side, some levered exposure, simply because the market at any given time is right. Not me, not you, not anybody, the market is the market. Now, could we gap down tomorrow, fall apart? Yes. All of that is always possible. But right now, it's telling me that I need to probably put on a little bit more exposure, regardless of what I think. And I bring this up, and I've spent almost 10 minutes telling you about this, pardon if it's in a roundabout way, but it's really important to think for yourselves about, you have opinions about which way the market's going to go. Sometimes they work and sometimes they don't, but in and of itself, the market is always right. And sometimes you're right with the market and sometimes you're wrong against the market. And you might be right 6 months from now, but if let's say the S&P just keeps going up, and then sometime in August something happens with the health scare or something, and the market reacts to it in a negative way. Well, do I want to sit here and potentially miss a whole up move? Because generally I've been bullish for actually years. And I'm still a big fan of the market over the long-term perspective. I think I have mentioned to you that back in 2014, it was June of 2014 when I was at Wells Fargo, I put out a piece. The S&P was trading at 2,000, and I said that within 10 years, the S&P will be at 5,000. So clearly, I am a long-term bull, and we're kind of on pace for that to happen. But there are events and certain things along the place that I'm more friendly and less friendly to the market. Right now, I'm kind of less friendly. But if we continue to stay above the 33, 36, 33, 38 old highs that we had just from earlier in January, then the market will force me to come back in. So I ask you as investors and traders to think about how often do you get stubborn about something where it potentially costs you money. And I think about it in terms of what can you do to adjust your thinking and your come from such that you allow yourself to partake in a market's move, even if you don't necessarily agree with it. So I've got one client who is very, very successful guy, supremely successful, and he's in his 30s, and he's waiting for a large pullback in order to put substantial money to work in the market. And I've encouraged him to put some of it in regardless of which day and time, because he's got a 30-year time horizon here. And it would seem silly to try to time the market when over 30 years, there's no better place to be in the market, to be in any investment than the stock market. So whether you paid $3,000 for the S&P or $3,300 for the S&P, it really won't matter 30 years from now. And he's missed a large portion, and continues to miss this simply because he's waiting for the S&P to pull back hundreds of points. And I even mentioned to him that when and if that occurred, you'd probably be so afraid to put money in. And this is very common on Wall Street. People always look for pullbacks to get back in. But then when you get a sharp pullback, people become afraid to actually do what they've been clamoring for months. So he's missed the up move and continues to, simply because he's waiting for a bigger decline to get in. And it may happen and it may not, but obviously, with a 30-year time horizon, timing the market is not too essential. So that's what I wanted to talk to you about, and why I said, it doesn't matter what we think. It matters what the market thinks and does. And collectively, the market is a compilation of all investors who partake in the market's psychology of bullishness and bearishness at any given time. And you've got to kind of pay attention to and give respect to what a market is telling you. So when we made this high here, and I said that I thought the S&P would stop at 33, 36 and kind of spend some time here, I said I would give it about 1% leeway on the upside, which is probably pretty close to where we hit 33.75 today. It's in the neighborhoods of about 1%. Now, market's tailing off a little bit intraday, but I might very well use kind of this level from today's high. If we get above here, it kind of forces me back in. Otherwise, I still think we're in a potential consolidation phase, and we'll just spend a little more time in and around here before ultimately moving higher. I've said to you guys before, I think the minimum upside on the S&P this year that it prints is 3,477, 3477. So about 100 points above today's high. It's not a year-end target. It's where I think we will at least get to at some point this year. So obviously it still means I'm bullish the market, and it's just a matter of where I want to add my exposure to. And just obviously at this point, if you're a long-time listener, you know how to contact me, rick@inthenotrader.com. Thank you for the emails I get after almost every show and the compliments. I appreciate it. Check out inthenotrader.com for videos, lots of them on psychology of trading, as well as how to sign up for our weekly newsletter that comes out Wednesday evenings by subscription. And again, I use the same models for this newsletter as I use for my institutional newsletter. I try not to cross the thought process of what we're investing in, just not to crisscross those two. But I use the same model. So you know that you're getting the same type of analysis I do for institutions, I do for you as individual traders. And that's why I created In the Know Trader. So we've got 2 weeks ago year-to-date performance on the left, and then so that was through February 3rd. On the right-hand side, through yesterday's close, only one sector, sorry, just bumped into the microphone, only one sector this week increased by 1% or more. That was technology, kind of reminiscent of last year. Technology leading the pack by far, nothing else even close to it. In performance terms, but you see here 4 sectors last week lost at least 1% in relative terms to the S&P. Those were materials, energy, staples, and utilities. Utilities kind of got hit hard last week as the stock market moved higher and a lessened need to get the flight to safety to treasuries. Of course, when yields go down, which of course is when bond prices go up, utilities often come into favor because they're high-yielding instruments, and investors often go into those when yields are falling on the treasury side to get better yields on the equity side. Of note, again, is the amazing, horrific performance by energy. Last year's worst performer, this year's worst performer. By far, it continues to be just a really bad place to invest in. And until we see some shift there, and it's not so easy with oil in the trading around $50 or so to see the energy names really do well. And of course, natural gas is under $2, so there's little incentives here other than for value players who kind of like cheap names, but you could easily be holding these for quite some time before you're going to make money. That's why there's other sectors that are moving more, and you have a better chance to do well in. Okay. So a listener of mine sent me this chart, and I appreciate his thoughts, and he actually helped give me the idea on what we'd take a look at this week. And again, I mentioned at the top of the show, we're going to look at the S&P in a variety of different ways and look at the differences that each one of these charts show, as well as then I will flip to the normal charts I use on CQG, because we'll be able to use the DeMark models to see what these same things say using the DeMark model. So first off, on the top of this chart is the S&P 500. This was as of yesterday. Obviously, again, we gapped to a high today. So we are just poking to new highs here. And in contrast, take a look at the second chart down in green, the S&P 500 equal weight, right? So instead of being a cap-weighted index, there is the S&P equal weight, where each one of the 500 names that make up the S&P 500 has exactly the same weight. That means the FANG type names and all the mega cap names do not have any more influence on the compilation of the index does than the 499th and 500th capped name in the S&P, right? It's an equal weight index. And what you can see here is that as of yesterday, the S&P equal weight index had not made new highs yet. So whereas the large cap S&P 500 did, the equal weight S&P 500 did not. So another clue that the large cap names are really leading the index, and it's not necessarily a broad-based rally. Now let's take a look at the red chart in the middle, the S&P 100. So this is the 100 largest cap names. When I say capped, I mean capitalized, right? So these are the largest 100 companies in the S&P 500, the top fifth. And this chart's different because this has already made new highs from the January high and significantly made new highs, which is another clue that the largest names in the index are the ones carrying the market higher. Chart, the fourth one down, SPX equal. So this is the equal weight S&P. This is a relative performance chart of the equal weight S&P to the actual S&P chart itself. And sorry. I call myself a cold down in, a cough and cold down in Florida. So pardon the cough. All right, this green relative performance chart is the equal weight divided by the normal S&P. And you can see that since I'd say it looks like June or so of last summer, this has slowly been trending down and then is kind of taking a dive here in the month of February, meaning that, again, the large cap names are outperforming. So because this is the equal weight S&P, as the numerator divided by the S&P 500 as the denominator. So as this chart heads down, that means that the equal weight is underperforming. So just a graphical way of essentially saying what charts, the black chart on top and the green chart on top are showing. Then the last one is the OEX, the S&P 100 divided by the S&P 500, and that is, of course, making its best high now that we've seen. Again, so the top tier stocks, the biggest 100, are well outperforming the other 400 names in the index. All this stuff essentially says the same thing. The largest cap names are carrying the S&P higher. And to show you just how important this is to understand how the indices move, take a look at, let's see if I can pull this up now. Here we go. So here's kind of a cool website that I occasionally look at, and the only thing I need is to find my mouse. See if we can. Okay, it doesn't want to play. Here we go. This is all 500 names in the S&P, and this tells you how many companies represent what percent weight. So the largest company in the S&P, and I think it changes daily between Apple and Google and Amazon. So I'm not sure which one's number one right now, but whichever one it is, it represents just over 5% of the total S&P. So one company out of 500 represents over 5%. 7 companies get you to 20%. So a whole fifth of the S&P is just 7 names. And I like to look at what it gets to get to 50%. So this is probably about as close. Here we go. 46 names, not even 1 in 5. All right, there's, I'm sorry, 1 in 10. 500 names in the S&P, less than a tenth of them is already half the weight of the S&P. And that's why it's so important to look at the FANG names and really the mega cap names, because they are what drives the S&P 500. Now, if you look at equal weight, obviously, then each one of it's totally different. The market still, as we saw, so now I can say goodbye to this. We saw that even the equal weight, it's near all-time highs. It's not quite there, but it's a bullish market. It moves higher. But it is the large cap names that are really the bulk of the performance that we see day in, day out. So now let's take a look at, I'm actually going to look at these in terms of the ETFs that are tradable rather than the cash indices. So here's the S&P, the spiders. Very similar, obviously, to the S&P 500 chart we looked at before. Gapped higher, has now down close. Look, so if this was our reference level, the TD risk level at 333.44, why is this no longer a dotted line? Why is this telling me it's been stopped out? Because we had a down close followed by an up close that was greater than that level, followed by a higher high, followed by a higher open and higher high. So this is now, this 13 signal, which is on the daily chart, is no longer meaningful. It is stopped out. So that's another reason why I've got to listen to what the market says. Let me just show you this on a weekly chart. Now the weekly chart, look at the last few 13s. 13 here in, when is this, 2018, the middle of summer of 2018, upside exhaustion. Obviously, big sell-off into that Christmas low, huge sell-off. Then the next time we get a possible exhaustion signal is spring of 2019, get a decent-sized 200-point decline in the S&P, 20 handles in the spiders, eventually turn around, keep going. Then we got one a few weeks ago. And we got it pretty much very close to the propulsion exhaustion level, which is what got me to say I don't want to be buying stocks here and now. We did, again, sell off, we sold off 100 handles in the cash S&P, and we've turned around. We're still within the context of the weekly 13. That has not gotten stopped out yet. That doesn't get stopped out until 338.54. So there's still some leeway here before we totally disregard that we've got some potential exhaustion of trend in the spiders, which is why I'll put on a small amount, but only a small amount of levered long exposure, depending upon how we close over the next couple of days. But important to take a look at this. Let's look at the OEX, but in ETF terms, which is OEF. And that has gotten to 13. That is right up against its stop out level. Now, it can't get stopped out this week because last week wasn't a close, but I'm still going to kind of pay attention to this 151.78 level. We're only 20 cents beneath it. So notice that the different charts have slight variations to them because they're all different ways of looking at the S&P 500. And then let's look at the ratio. And the ratio quickly is falling out of bed. This is equal weight versus, this is the 500 versus the 100. And the last one is OEF SPY. This looks like it may be breaking out to the upside. Did have a 9 count here, so we've got to kind of watch this, but this is potentially breaking out. That's the S&P 100 divided by the S&P 500. Well, folks, time is up, and we've gone through it very quickly. Again, the 30 minutes disappear. Thank you for tuning in. I'm Rick Bensignor. This is In the No Trader.